Welcome to Mindful Journey, your go-to guide for all things finance. We're here to demystify the world of investing, taking you from the basics to the complex strategies used by seasoned investors. Whether you're just starting your financial journey or looking to expand your horizons, Mindful Journey is your reliable compass. We simplify financial jargon and provide practical advice to help you navigate the financial landscape. So are you ready to embark on this journey with us? Join us on this journey to financial enlightenment. Investing is not just for the wealthy. It's a tool everyone can use to build wealth. Let's unpack this. You see, investing is essentially the act of committing money or capital to an endeavor with the expectation of obtaining an additional income or profit. It's a way for you to put your money to work rather than letting it sit idle in a savings account. When you invest, you're aiming for your money to grow, helping you achieve various financial goals. It could be buying a house, starting a business, or even securing a comfortable retirement. And the secret sauce? It's compound interest. This is when the interest you earn on your investments starts to earn its own interest. Over time, this can result in exponential growth. Investing isn't just about making money though. It's about securing your financial future and achieving financial independence. Remember, investing is a step towards financial independence. There's a whole world of investment options out there. Let's delve into it. First up, we have stocks. When you buy a stock, you're essentially buying a piece of a company. Stocks have the potential for high returns, but with that comes a higher risk. If the company performs well, the value of your stock increases. But if it doesn't, well, your stock value decreases. Next, we have bonds. If stocks are buying a piece of a company, bonds are more like lending money to a company or government. In return, you're promised your money back, plus interest over a set period. Bonds are generally less risky than stocks, but the potential returns are also less. Then we have mutual funds. These are a pool of funds collected from multiple investors to invest in securities like stocks, bonds, and other assets. Mutual funds allow you to diversify your investment, reducing your risk. But remember, the returns depend on how the securities in the fund perform. Let's talk real estate. Buying property might seem daunting, but it can be a lucrative investment option. Whether it's rental income or selling for a profit, real estate can provide stable returns. However, it requires a significant initial investment and comes with its own set of risks like property damage or market fluctuations. Lastly, we have exchange-traded funds or ETFs. These are similar to mutual funds but can be traded like a stock. ETFs offer a way to invest in a broad market sector or index with ease. They provide the diversity of mutual funds and the flexibility of stocks. Now, each of these investment options has its own potential returns and associated risks. It's important to consider these factors and do your research before making a decision. Remember, there is no one-size-fits-all in investing. The best investment for you depends on your financial goals and risk tolerance. So take your time, understand your options, and make informed decisions. After all, investing is not about getting rich quick. It's about creating wealth over time. Investing is a balancing act between risk and reward. This principle is the cornerstone of all investment decisions. It's like a dance, where you're constantly adjusting your steps to the rhythm of the music. Let's break it down. Imagine you're planning a trek. The more challenging the trail, the more breathtaking the view from the top, right? But there's also a higher chance you might stumble or the weather might turn. Investment works pretty much the same way. The higher the potential return, the greater the risk involved. So, you might be wondering, how can I enjoy the view without falling off the cliff? That's where diversification comes in. It's your safety harness. Diversification means spreading your investments across different types of assets, sectors, or even geographical regions. This way, if one part of your portfolio takes a hit, the others can help balance it out. Think of it like this. You wouldn't put all your eggs in one basket, would you? Well, the same logic applies to investing. By diversifying, you're not just relying on a single investment to perform. Remember, the market is like a roller coaster. It has its ups and downs. But when you diversify, you're more likely to stay secure in your seat and enjoy the ride. In the end, the goal isn't to avoid risk, it's to manage it. And the key to managing risk is understanding it. A diverse investment portfolio can help you weather market volatility and reduce risk. Investing can seem complicated, but with the right strategy, it becomes a lot simpler. Let's begin with a common phrase you might have heard: start small. This is not just a comforting phrase, but a sound strategy. When you're just starting out, it's wise to begin with a small amount that you're comfortable potentially losing. This approach helps you understand the market dynamics without risking a large portion of your savings. Our next strategy is regular investing, also known as dollar cost averaging. This means investing a fixed amount on a regular schedule, regardless of the price of the investment. This strategy takes advantage of market fluctuations and reduces the risk of making a large investment at the wrong time. Lastly, we have long-term investing. This strategy involves holding onto your investments for several years, allowing your assets to weather short-term market fluctuations and potentially reap larger returns over time. Remember, investing is not about getting rich quick, but about consistent growth over time. Congratulations! You're now equipped with the basics to embark on your investment journey. Remember, the world of investing is vast and ever-evolving. Use what you've learned today as a springboard, dive deeper, and continue to expand your knowledge. Don't hesitate to start your journey, because sometimes the first step is the hardest. If you found this video helpful, make sure to like, share, and subscribe. Also, drop a comment below if you have any questions or topics you'd like us to cover in future videos. Until next time, keep journeying mindfully towards financial success.